The concept of the black tax refers to the myriad of systemic financial burdens, discriminatory practices, and societal expectations that disproportionately affect the Black community, thereby hindering our ability to build generational wealth and achieve economic stability. These are not literal government taxes, but rather a collection of economic penalties and wealth extractions that reflect challenges Black Americans have faced for decades and continue working to overcome in the pursuit of financial equity and generational wealth. Payday loans have become one of the most predatory tools draining wealth from low-income and Black communities across America, and payday lenders often target African Americans in immediate financial distress by setting up storefronts in predominantly Black communities, even when adjacent white communities have the same income. These small personal loans offer quick cash advances that are due on the next payday, however, at a high interest rate that sometimes fall around 400%. The result is a revolving debt trap and a black tax that extracts wealth from Black communities already struggling to stay afloat. Historically, Black individuals are overrepresented in this area. Although Black Americans make up around 14% of the U.S. population, we represent 23% of storefront payday loan customers. Moreover, a study estimated African American households are 3 times more likely to use payday loans versus white households. Being unbanked doesn't just mean lacking a checking or savings account. It means living outside the gateway to financial security. When excluded from the modern financial system, the unbanked are pushed into a predatory ecosystem of pawn shops, check cashing outlets, money orders, prepaid debit cards, title loans, and payday lenders where desperation is monetized and financial survival comes at the highest cost. This black tax can be somewhere between 3% and 5% of the transaction, which over a lifetime can amount to thousands of dollars lost, just to access one's own earnings. Also, Black people without a traditional banking relationship are not able to build a financial footprint, excluding them from homeownership, low-interest personal credit lines, affordable business loans, and consistent savings tools. Black Americans are nearly 5 times more likely than their white counterparts to operate through life without a bank account. The constant cycle of fees, keeping up with cash, along with the anxiety over late payments, creates a persistent state of financial stress that undermines long-term stability and wealth building. When an account holder attempts a transaction without sufficient funds, banks charge an overdraft fee, which typically costs $35 per incident. A single week of low cash flow can trigger multiple overdrafts as automatic payments hit, snowballing into hundreds of dollars in fees. For individuals managing finances on a paycheck-to-paycheck basis, this cycle of fees can rapidly exhaust an already precarious budget, severely impeding their ability to recover financially. Consequently, many Black Americans opt to avoid this black tax altogether by abandoning traditional bank accounts. Although they're able to escape these punitive charges, this decision leads them into the trap of the unbanked, where they have to rely on alternative financial services like check cashing stores, payday lenders, and all of the ones mentioned earlier. Black students graduate with some of the nation's highest student debt burdens, often borrowing more to cover tuition due to limited family wealth and very few financial alternatives. This debt frequently stalls major life goals such as purchasing a home, starting a business, or building retirement savings, key drivers of long-term stability. Nearly half of all Black families carry student loan debt, compared to only 1 in 4 white families, with the average Black college graduate owing more than $50,000. Redirecting this black tax toward investments and asset growth could create lasting financial freedom and lay the groundwork for generational wealth. Black individuals often face lower credit scores due to systemic factors, leading to higher interest rates on loans, credit cards, and other financial products. This means they pay more for borrowing money, eroding their financial resources. For example, with a 30-year mortgage on a $200,000 home, you can easily pay tens of thousands of dollars more in interest over the life of the loan with a credit score of 625 versus 725. In fact, this black tax amounts to a difference of over $75,000 in interest paid that could go towards kids' college savings, life insurance policies, and emergency savings accounts. And for Black first-time homeowners who are denied loans or credit approval from conventional banks, they are often forced to turn to subprime lenders, where even a small financial setback can trigger missed payments, foreclosure, or long-term financial devastation. Buy here, pay here. Car loans are especially devastating for many Black consumers who often turn to these dealerships after being denied conventional financing. These lenders charge extremely high interest rates and inflated prices for used cars, creating monthly payments and a black tax that stretches an already tight budget. Because the contracts allow for swift repossession after a single missed payment, dealers profit by repeatedly reclaiming and reselling the same vehicles within the same communities. The cars themselves are often older and costly to maintain, carrying high insurance rates and frequent repair bills. In the end, Black borrowers pay far more than the vehicle's value, trapping them in a cycle of debt, instability, and a depreciating asset. And let's not forget the buy now, pay later model. These flexible payment options offered by companies like Affirm, Klarna, and Afterpay can be equally harmful to Black consumers. Enticed by instant access to goods, luxury items, and even vacations, you find yourself in a precarious situation where you've taken on debt for instant gratification rather than needs. These plans lock consumers into a monthly black tax payment system with hidden fees, interest, and strict penalties for missed payments, causing them to end up paying significantly more than the original price. The cumulative effect is an erosion of wealth. Money that could have been saved or invested is instead diverted to service microdebt, reinforcing cycles of consumption over capital accumulation in the Black community. Rent-to-own stores exploit financial vulnerability by promoting the enticement of a no credit needed promise that appeals to individuals shut out of mainstream credit systems. For many Black consumers already burdened by lower credit scores or lack of savings, these offers provide short-term relief but create long-term financial harm. Customers end up paying 2 to 3 times the retail value for furniture, appliances, and high-end electronics, with mind-blowing weekly or monthly payments that stretch budgets and rarely build credit. For many Black consumers, already burdened by lower credit scores or lack of savings, these offers provide short-term relief but create long-term financial harm. If a payment is missed, the item can be repossessed, erasing months of payments and leaving the buyer with nothing to show for it. This business model thrives on financial instability, extracting wealth from communities that can least afford it and converting everyday necessities into ongoing liabilities. In essence, the no credit needed promise becomes another form of the black tax, a penalty for exclusion from fair and affordable access to ownership. When a Black homeowner submits their property for appraisal, either for sale, refinancing, equity loan, or insurance, the appraiser, consciously or subconsciously, devalues the home relative to similar white-owned homes in the same neighborhood. That undervaluation reduces equity, lowers borrowing power, increases the mortgage risk cushion demanded by lenders, and constrains wealth that could have been captured. A Brookings research estimates that the median appraisal for Black homes come in 15% lower than what sales prices and comparable characteristics would predict. They also found that 20% of all homes in majority Black neighborhoods have been devalued through the home appraisal system. For a $300,000 home, this is a black tax of $45,000 that could serve as a powerful engine for intergenerational stability, opportunity, and freedom from debt. Many Black homeowners have resorted to whitewashing their homes, removing family photos, Afrocentric art, and cultural decor to conceal their racial identity during the appraisal process. Some even ask white friends or colleagues to stand in for them during the appraisal visit, a desperate but telling measure to secure fairer home valuations and protect their property's true market value. Black Americans are more likely to be uninsured or underinsured, delay or skip medical care due to cost, and receive lower quality treatment, all of which drive up out-of-pocket expenses, hospitalizations, and emergency care use. Chronic illnesses like hypertension, diabetes, and kidney disease are more prevalent and progress more aggressively in Black communities, often due to social and environmental factors, leading to higher lifetime healthcare costs. Not to mention, Black communities are disproportionately located near polluting industries and hazardous waste sites, leading to higher rates of chronic illnesses. By age 75, a Black American typically faces greater medical debt, more health complications, and higher cumulative medical spending than a white counterpart, largely because of reduced access to consistent preventive care. A recent study estimated that the median cumulative lifetime healthcare spending for Black adults between ages 40 and 80 is about $585,000 compared to $205,000 for white adults. Additionally, the shorter average lifespan of Black Americans, about 5 years less than whites, carries its own hidden cost: lost earning potential, fewer retirement years, less time with family, and diminished opportunities to build generational wealth. In this way, healthcare disparities function as a Black tax, draining financial resources and shortening both economic and physical longevity. We appreciate the fact that you stayed until the end. Thank you for spending time with us, and don't forget to like this video. Also, make sure you subscribe so that you never miss a video. Bye for now. We will see you tomorrow.